The first step in saving for retirement or any other financial goal is deciding where to invest those hard-earned savings. Today I will break down your account options into 3 buckets: taxable, tax-deferred, and tax-exempt. These accounts have their own unique tax implications, and it's important to understand the differences between them before making contributions each year. The first bucket we will consider is taxable. Examples of taxable accounts include checking, savings, and brokerage. Here you invest money with after-tax dollars, meaning you don't get any tax benefit when you make contributions. Any earnings or capital gains in the account are subject to taxes in the year they are realized. Earnings are most commonly dividends or interest. Capital gains are the profit from the sale of property or an investment. Our second bucket is the tax-deferred account. Examples of tax-deferred accounts include traditional IRAs, 401ks, and 403bs. Contributions are made pre-tax, giving you an immediate tax benefit. The earnings in the account grow tax-deferred, which means you don't have to pay taxes on them until you withdraw the money. Unfortunately, you don't get to defer that growth forever. The IRS implements harsh penalties if you do not meet required minimum distributions, or RMDs, from tax-deferred accounts. These RMDs start as early as age 72 and are a means for the IRS to collect their tax revenue. Our third bucket is the tax-exempt account. Examples of tax-exempt accounts include Roth IRAs, Roth 401ks, and Roth 403bs. A tax-exempt account is where you invest money with after-tax dollars, but the earnings and withdrawals are tax-free. This is effectively the exact opposite of a tax-deferred account. The trade-off between the two is if you want to pay your tax now or later. One little caveat that makes the tax-exempt account shine, however, is that they are not subject to RMDs. This is because you've already paid the taxes on the front end. One outlier that doesn't fit into any of these buckets is the health savings account, or HSA. Contributions are made pre-tax and earnings and withdrawals are tax-free if used for qualified medical expenses. This combines the best aspects of tax-deferred and tax-exempt accounts. The limitation is that contributions are limited to those with a high-deductible health plan. So, when do you need to consider when choosing between these 3 buckets? First consideration is when the assets are needed. This is where the taxable accounts stand out. They offer the greatest flexibility, while the tax-deferred and tax-exempt accounts have strings attached on when the full funds can be accessed without penalty, along with annual contribution limits. The tax benefits are too great to ignore, however, and all 3 buckets are often used in a well-rounded financial plan. When deciding between tax-deferred or tax-exempt, the question really comes down to if you think you will be in a higher tax rate today or when you withdraw the funds in the future. If your tax rate is higher today, tax-deferred contributions are preferred. If your tax rate is lower today, tax-exempt is preferred. If we apply this concept over your lifetime, the strategy becomes how to smooth your income over each year so that you do not have any large earnings in any one year that can push you into a higher tax bracket. This applies to your working years as well as in retirement. A detailed financial plan is important to track assumptions and lay in tax considerations like required minimum distributions. The list of assumptions and considerations is long, but includes things like Medicare premiums, Social Security, income tax, college financial aid, long-term capital gains tax, and tax credits.